And, as everyone says, history does not repeat, but it rhymes. And, for me as well, Andy, that's my framework because I fell into mortgage in 2006, September of 2006. And so where we are kind of from a delinquency perspective, we've kind of been sitting on the edge of Q4 2006 for about a year because what happened last year so there's all different loan programs. And let me just start out by saying what some people may not know is that the government in one form or another, be it the government sponsored enterprises, Fannie and Freddie, FHA, other programs, they own the majority of the mortgages out there, almost 85%. And this is a big shift and change since that time period you're referencing. I refer to it as the GFC or the Great or Global Financial Crisis, whatever you want that G to stand for. And so basically, back then, we had a lot of risky lending that was being done by the private sector, by the banks, actually, right? But what happened is post that, the banks really pulled back due to Basel III requirements. They didn't want to hold mortgages anymore. And so the government stepped in to keep the market going. And these non-banks, basically what they do, like Rocket, UW, those companies, they will originate your loan and then they immediately turn around and sell it off to Fannie or Freddie or somebody like that.
Or Wall Street, right?
Or Wall Street, and then that's another very something we'll talk about. We can do it right now. Something Fannie and Freddie also do and FHA do is they sell off their non-performing loans to Wall Street, to hedge funds, to people, so that their delinquency doesn't look that bad right now. As well. And what happens to those loans is they sort of go in a black hole to hedge funds who then maybe sell those out to even smaller investors. And so we don't get credit reporting on many of these.
Okay. Can I interrupt
Sure.
you first? Can we
Absolutely.
define some terms?
Got it.
FHA. What is FHA?
So it's the Federal Housing Administration. I always used to always thought stood for a first time home buyer, but it does not. It's the Federal Housing Administration. And the GSEs are Fannie Mae and Freddie Mac. And so, and this is, thank you for stopping me because Andy, FHA is a key to this story. And so back during the time that you and I, remember with horror, FHA was a very small percentage of the market, only about 7% or so. Well, fast forward to today, what you had was just record unaffordability even before COVID. Okay. And so
Yep.
the government needed to get people into housing because that securitization machine, which if you've watched The Big Short, everybody can kind of understand that concept now. They package up these loans and sell them off as securities. So they needed that to keep going. And so what they started doing was bringing in riskier and riskier borrowers. As well as there's all kinds of generous down payment assistance programs that really got juiced with the COVID American Rescue Act stimulus. And so FHA went from about 7% of the market to anywhere between 13 to 15% of the market, which is exactly the size of that private subprime market last time around.
Okay. Time out. Time out.
Yeah.
Okay. So I
Okay.
want to get the time right. So it went from 7% of the market. You said 15% of the market when
13 to 15%.
13 to
It just grew from that time period to today.
today.
Yeah.
Okay. So, and I'm interrupting you, but
No,
again,
go ahead, please.
this is just relabeled. This is the new subprime.
Correct. I call it government
You're killing me.
subprime.
We are screwed. Go ahead. Okay.
So FHA. So,
That's why I haven't heard it. They call it FHA now instead of the subprime market. Got it. Okay.
right.
Got it.
I refer to it as government subprime because that's exactly what it is. You can go as low as 580 credit scores with compensating factors. And here's the crazy thing. We know that credit scores were inflated during COVID because of eviction moratoriums, mortgage forbearance, student loans not reporting. And
Mhm.
so you had these inflated credit scores, and there's all kinds of studies. The Fed has done a study on this. This is the reality. This is why so many people had their credit score drop when they started reporting student loans again. So basically, FHA really went after that risky borrower, same risky borrower from before, And we know that, the stripper, the investors, well, they used FHA back then too, illegally. Is what they'll do is so FHA, you only have to have a 3.5% down, and even then, like I said, there are down payment assistance programs. And so what happened is investors use this program illegally, and they claim that they're going to be an owner occupant. And this is going to be their primary residence. But really, what it is they bought it to do long term rental or short term rental. Most everybody changed to short term rental because they thought they could get more money based on ridiculous underwriting tools that weren't based in reality. So anyway, so this we're if you think about what happened at the end of the last crisis, the foreclosure crisis just kind of disappeared, right? In some
Right.
ways. Well, that was because Wall Street came in at the behest of the agencies, Fannie and Freddie and FHA, and they just started buying up all these properties at auction. I went to those auctions, and I can tell you, everybody has to kind of get out this idea that the banks want to foreclose. Nobody wants to foreclose. It is one of the most expensive processes. So these banks were just like, thank you, please take them, whatever, just take them.
Mhm.
And so then that kind of started a trend where every mom and pop was like, well, hey, I'm going to do that because more and more the social contract really got broken during COVID, but it was getting broken before then where you work for a company, there was no loyalty, they'd be like, goodbye, you're gone.
Mhm.
And so people were like, okay, as well as wages just weren't keeping up, right? And so they're like, how am I going to get mine? I need some kind of plan. And so many people got thinking it's passive income, which is hilarious. Being a landlord is not a passive job. And so, everybody piled in, the Kardashians were, the biggest real estate influencers. They're turning houses, HGTV, all of this. Okay, we hit COVID and you had YouTube influencers just pop up everywhere, invest in multifamily, invest in short-term rental, Airbnb. And then Airbnb was really smart about what they did. I don't agree with it. I'm just saying they would limit the amount of listings so when you search, let's say you were going to San Diego and you search Airbnb, they're going to show you 1,000 listings. And so everybody thinks, well, 1,000, okay, 1,001 in San Diego, I'll do fine. No, there are 15,000 short-term rentals in San Diego right now. We don't need 15,000 mini hotels. And so anyway, everybody piles into this. They use these FHA loans illegally. This is
Oh
what you've
gosh.
heard, and this is the Lisa Cook nonsense, right? This is what they're accusing her of doing. By the way, everybody does it. I mean, I can tell you, everybody does it. It's the biggest,
Mhm.
secret in mortgage, and no one has really been enforcing this at all, which they should. And the Fed actually put out a paper in January 23, the Philly Fed, that said, hey guys, investing in real estate didn't stop after the GFC and the fraud didn't stop. And by the way, anytime you have investors participating like this, it's about 30% likely there's fraud. Like 30% of this origination is fraud. And so, anyway, what happens? Okay, June of 23, we start to see mortgage delinquency in FHA, like really bad delinquency. And I'm pounding the table. Nobody cares, basically. They're not paying attention. Everybody argue with me. It's just a small percentage. I'm like, oh, you mean as small as subprime was. So, we need to start paying attention. Well, we come around to 2024 election year, and they could not have this happen. You remember we were being lied to about the economy. And so Biden administration comes out with this crazy loan modification and workout, um, back during the day, when I worked at a big top 5 originator and servicer, when you did a loan modification, you had to re-underwrite them. You had to look at their financials. If they couldn't do it, it didn't make sense. They were denied, unfortunately. But listen, they can't afford it. They can't afford it. Back then we broke contract law. It's a big reason we are where we are today. Well, so what this program did is you didn't have to, so during COVID, you didn't have to apply for a workout. In fact, you didn't even have to call the servicer for the forbearance. They just put you on it automatically. And then when your forbearance ended, they would send you a modification in the mail. They never asked for your financials. They didn't need them. Well, so if that weren't bad enough, that didn't keep everybody in their home. They did this new partial claim supplement program where you could just go delinquent. Let's say you went delinquent for 3 months. They would take that balance, put it on the back of the loan, a non interest bearing lien to be paid off when you pay off the loan or sell the home. Well, let's say you don't pay again. You go back and tell them, I can't pay. They do it again. And you go back and you tell them, I can't pay, and they do it again. And my colleague, John Comiskey, has done the work on this, diving into these. And anybody who's had a partial claim is 5 to 7 times more likely to go delinquent again. I mean, that is just an unbelievable statistic.